Thank you for watching this video. This tutorial video is brought to you by newqviewer.com. newqviewer.com, your one-stop QuickBooks online learn and share blog. In this video, we're going to focus on journal entry, debits and credits. So let's start with understanding journal entry first. So in journal entry, basically you have debits on one side and credits on the other side, and the total should match. So let's analyze debits, and then I will also analyze credit side. So on the left side you have debits, these are all debits. On the right side you have credit, these are all credits. Alright, let's go through one by one. So let's stick with the balance sheet assets accounts first. So the bank is debit. So whenever you deposit your money to your bank account, it's debit, it's your asset. Whenever you invoice your customers, clients, and you have accounts receivable or your clients owe some money, that's on the debit side. And on the other current asset, it could be you give some money to employees, temporary advance, that's your current asset. Or it could be you bought some inventories for your business, that could be current assets. On the fixed asset side is basically you buy your capital assets. You bought a computer, you bought some furniture for your business, and you want to capitalize it and uh, depreciate over a certain time frame. So that's on your fixed asset side. That's also debit. And other long-term assets could be your intangible assets, uh, or could be loan type. You give some money to certain people, or you invested in certain business for long term, so that's your long term asset on your books. And on expense side, on the P&L, cost of goods sold is debit. Operating expenses, any operating expenses, telephone, utilities, payroll, rent, whatever, it's all operating expenses. And then you have a one-time expense, that falls below your operating income line in the P&L, so that's also your expense. And on the balance sheet side, liabilities, these are all credits. Accounts payable, you bought certain materials and your vendor gave you certain terms, like they said you can pay us in 30 days, and you set up accounts payable, so that's your liability, so that's your credit side. And you have credit card liabilities, and you use the credit card and you have liabilities on your books, so that's also credit card credit side. And other current liabilities, it could be short term, you owe that money, like a payroll liabilities, or any other liabilities, that would be your current liabilities. It could be accrual, or your deferred revenue or income type, you know, or short-term loan from your bank. Is all credit side on your balance sheet. And the long-term liabilities, you borrowed money from your bank, and let's say it's a 5-year term loan, and so anything over 12 months or 1 year, it goes to long term. Anything 12 months or under 12 months, it goes to current liabilities. Same thing within here, the current asset, 12 months or less, and 12 months or higher, that's the long term. And the equity side is always a credit. Opening balance equity, you convert it from your a certain accounting system, and you start out with the opening balance. The positive is your credit, and if it's negative, then it's the debit side. It's the reversal of credit. And owner's equity, you put money to your business, that's also credit. And retained earnings, if you have profit, that's positive, that's credit. If you have loss from your business, cumulative loss or cumulative profit, cumulative loss is negative. Cumulative profit is positive, that's credit. Negative is debit. And income side is a regular business income. That's always it's credit side. You invoice your customer, that's debit, and you recognize income, that's your credit. And then the other income, one time extraordinary type of income, it will also fall under your operating income or loss, like uh, one time you sold some business and one time income, or you sold fixed assets, you have gain, uh, and you want to see you don't disturb this line with operating income, then it falls below your operating income. So that's just for your business reporting purpose. Okay, so let's go through the journals terminology we use: the standard journal entries, recording type, adjusting type, correcting, reclassifications, and reversing journal entries. Okay, the standard is basically, it could be for anything. It just could be for accrual, or just the uh, you want to enter certain expenses and you just want to write journal entry for a business. So that's your standard. And recurring is you just want to automatically enter certain expenses on a regular basis, basically the same amount all the time. For example, it's depreciation. You have depreciation and you just want to expense it the same amount all the time. Or you may have prepaid expense or deferred or income type. You just want to, amortize over a certain period, all the same time, same amount. Adjusting journal entries, basically it's prepared by your accountant, and it's exactly the same form. Basically, it's the you'll just have your income. You'll say in form. You'll say adjusting is just adjusting journal entry, and you just click say yes. So you're going to have a accountant version for that. So normally, if you just have a regular QuickBooks or regular uh, you know, mm, online version, then you won't have this adjusting line. But this basically is, journal entries all the same. You just click the this one line, will say adjusting, and the correcting entries is basically you record certain expenses and you want to correct it, and you don't want to go through other stuff. So just write a journal entry to correct your previous or either standard journal entries or post it from other modules. And reclass is it's basically uh, reclass within could be within your P&L, or could be within your balance sheet accounts, or could be within your class or locations tracking if you have a QuickBooks Online Plus. And reversing entry is basically you accrue certain certain transaction and you want to reverse it next month. So you want to see you want to create accrual for this month and reverse it next month for payroll, for example. Okay, so these are the ones, and let's just go through one by one in here. Okay, so uh, to create, to write journal entry, you have right here plus sign and then journal entry right here. As you can see here, it's all debits and credits, and behind the scenes, all transactions have journals with debits and credits. Normally, you won't need to write journal entry because they have designated modules for entering just about any transactions. From here, create invoice. These are, you have all designated modules for anything. Let us see in here, invoice. You create invoice, and if you look at the previous invoice, you will see you may not have noticed it, but I'll show you right here. It's a transaction journal. So these are the behind the scenes. Everything is debit and credit here. As you can see here, it's debit and credit. The form looks exactly very similar to your journal entry type. As you can see here, debits and credits and account from your chart of accounts. This is your chart of accounts. So select your account from chart of accounts. Same thing in here. So this is the one for invoice. When you create invoice, it's debit AR, credit your income, sales income account. As you can see here, right here. Let's check another one here. Bill, vendor bill. Let's look at the historical ones. Right here, advertising, it's already paid. Transaction journals. Right here, accounts payable, credit, and debit is your expense account. That's for the bill. So when you set up your bill, it's expense debit, and credit is your liability account, accounts payable. Okay, so let us create certain expenses in here. All right, let's assume you are a small business and you just want to do one journal entry at the month end. Don't want to bother with entering from any of these modules in here. Just want to enter one entry at the month end. Use your credit card or certain debit cards, and you just want to go through all this, and you just want to enter one entry. Okay, so in that case, it's basically account. Just select expenses from your, let's say, your bank statement or whatever. Okay, let's say dues and subscriptions, $100. So you get all these numbers from your, let's say, your personal credit card or personal debit card, whatever. And let's just say you do some advertising, another 2,000 advertising in here. And you bought some materials, let's say, another 2,000, like this. Okay, so if you have used credit card, you just select the credit card account. Right here, Visa credit card. So this is you have credit card set up in your chart of accounts as a liability. There's 5,000 in here, and in case, let's say, you use your personal credit card and you just want to set this up as your equity bonus contribution. I don't have that account in here, so just create one. All right, bonus equity, 5,000. So okay, here we go. So owner's equity is right here, is credit, and expenses all debit. So this is one. All right, I'm going to save this and create another one. Okay, so let's create another one. Let's say you have depreciation expense. Let's say you have capitalized something and you want to expense it $100 a month. Okay. So depreciation expense $100 and cumulative depreciation is $100. Now say you want to make recurring type, recurring journal entry. Just click this one and you want to start. Let's say you want to do it like first of every month, and you want to do it 60 months, 5 years. Save template. So every month on first day, it automatically let's just say next year. You want to go back. There we go. So that would be like recurring type every month. It's recurring now. So you will see it here, recurring transactions. As you can see here, every month, you know, you will depreciate a certain amount, $100 every month, starting next month. So that's recurring zone entry. Okay, so we got a recurring journal entries, and adjusting journal entries is basically your accountant will do it once you close the books, or if your accounting is reviewing your accounts every month, and if they see something needs to be adjusted, then they will write adjusting journal entries. And correcting journal entries, let's just stay with the standard first, and let's say you want to accrue, do the accrual entry. Let's say you want to just follow the GAAP rules, accounting rules, and you want to accrue payroll. Payroll expenses. Let's say you want to accrue, let's say for 5 days of December, and somehow you computed $12,000 accrual expense that you want to enter as expense in December. Let's say you want to accrue for like these days, and you have your payroll through, let's say, 26, and you want to accrue for 27, 28, 29, 30, and 31. Let's say you want to do zone entry on 27 to 1,000, and this is the accrual, and if your liability, there you go. I'm going to save this, and I want to reverse this in January, first day of January, let's say. So this is a reversing zone entry. Or make this a reversing entry on first day of 2016. The reason is you'll have your actual payroll. So you'll be basically you'll have your actual payroll come in, and you place by actual payroll, and you just do the reversal of this entry. And on P&L side in January, there's no impact. As you can see, the reversal. Last month when you did accrual, it was 12,000 debit and 12,000 credit. Now it's reversal, 13R. So on first day of 2016, or you can change date if you want. Let's say you won't see actual until 9th. You can just change it to 9. So that's one thing. Okay, and now let's look at the other one. Uh, let's say you paid expense to your insurance company. Let's say you paid insurance for a business, and it happens to be for, let's say, 12 months of next year, and you want to amortize or write it off as every month. So this one goes to your prepaid expense account when you make the payment. Prepaid expenses. Let's say this one is for insurance. Okay, let's say this is from January 1, 2016 through December 31st, 2016 coverage. And let's say the amount is 12,000. So it goes through prepaid expense. It will show up in your balance sheet as current asset. And let's say you use a debit card. Okay, so now you want to write it off every month using a journal entry form. So it's insurance is your debit expense. Insurance 1,000, and credit is your prepaid expense account for that insurance right here. And you want to do it, let's say every month on first day, and you want to make it recurring. So start date January 1, end date here we go. So that's the prepaid write-off. Okay, so let's just do the reclass. Let's say you did one entry, and you recorded rent, and let's say that rent includes some utilities. So it's basically utilities, debit, let's say $100, and credit is your rent for $100. So this is your reclass type. As you can see here, there's no P&L impact, but when you wrote the when you enter transaction, basically, by mistake, $100, is for utilities, and you just want to, reclass. So this is your reclass entry. So reclass entry. Like this one, and it's only entry date. And if you have a QuickBooks Plus plan, you may also have a class or location. And if you just want to reclass from one class to another, you can do the same thing. Okay, so we went through almost everything. The correcting entries is basically just the correct the standard only entries. We went through recurring, adjusting, correcting, reclass, and reversal. And so the only entry could be for anything, let's just say you own business, and you want to do like let's say uh, let's create one invoice in here, and somebody wants to pay you uh, for like a maintenance type. So create invoice, customer, let's say Simon Construction. All right, this is maintenance. So what you want to do is, let's say you invoice your customer for 24-month advance maintenance invoice. So you know you want to defer this income, let's say, defer this income and set it up as a recurring type. So in order to do that, the maintenance has to be, you have to treat this as your deferred income first, or set up as liabilities. That's what it is, deferred income means. So you need to go to product and services. Okay, here's the maintenance, and this happens to be income type. Income type. So you want to create deferred type. So create a new one. Let's say service contract. Let's say. Okay, instead of choosing an income account, you want to choose your deferred income account. It will be on a liability, set it up as liability, just like your retainer type, exactly like this. So I'm just going to create a new one. Okay, so here you can create a new account, so you have to go to chart of accounts and create a new one. So it'd be like other current liabilities. Okay, so I have deferred income type. Now I can go to product and services and create a new one, services type. So this is where you want to select your deferred income as current liabilities account. So if you want to make this taxable, then you have to select this. Normally the service is not taxable, let's say. So now you can create your invoice. Service contract. This is 12,000. Let's say this is from January 1, 2016 through December 31st, 2016. Okay, so you have your invoice. Now you want to create recurring journal entry for your deferred income. So what will be your credit now? Service income is your credit, $1,000. So what will be your debit now? It's a deferred income. This one is a debit. It's sitting on your liability account right here. Current liability is debit. Right here. Current liabilities, when you set up is credit. So when you want to reduce it, it's debit. And you want to make this recurring. Let's say you want to do it first of the month. There we go. Save template. Yeah, that's what you have to do. Okay, so one more time. Debits and credits, balance sheet assets, bank is debit, accounts receivable is debit, other current assets debit, fixed assets debits, other long-term assets debits. On expense side on your P&L, cost of goods sold is debit, operating expenses, overhead is debit, and one-time expense that falls below operating income is your debit. On the credit side, balance sheet liabilities, accounts payable is credit, credit card liabilities credit, other current liabilities credits, long-term liabilities credit, and on the balance sheet equity side, uh, opening balance equity, normally this would be zero once you do the right treatment in your balance sheet accounts. But when you first create it, if there's balance, it's credit. Owner's equity, it's also credit always. And retained earnings, if there's a profit, it's credit. If there's a loss, it's negative. That's debit. On the income side, it's business income, always credit. And same thing with one-time income or external income that falls below your operating income or loss. So that should do it. Subscribe to our YouTube channels. We have two channels, BP Controller, New QBO, BP Controller, and New QBO. Like us on Facebook and visit our website, newqbo.com. Thank you.